I'm seeing so many bad takes on the coming real estate market crash and the near-term forecast for the real estate market. I get asked this question on a fairly regular basis, what my thoughts are on the real estate market, and I'll share them very briefly. I will say some of these articles I'm seeing in the comments are so ridiculous. I saw one on a very well-known financial website. I was checking the markets earlier this week, and markets had closed and happened to close up that day. And the headline said, and I'll paraphrase, it said something to the effect of, Dow rallies as investors find the bottom. And I'm thinking, that's it? That's the bottom? Is this official? We can all just buy the bottom now and it'll go up? And I'm thinking, no one knows the bottom. I mean, it's so silly. No one knows when the real estate market's going to crash or to what extent or severity. There's not a person on the planet that knows when that's going to happen. Now, you can look at the current state of the market and ask yourself, is it bad or good? And you can look at indicators that will predict how it's going to be or the direction it's going to move in the very near future. And we'll talk about that in a second. But even articles, I saw an article this morning, Blackstone prepares a record $50 billion to snap up real estate during the coming crash. And I'm thinking, that's not how it works. I actually saw a person that commented with what I thought, and people were just roasting this person. But basically, what this person said, which I agree with, is that usually you don't see stockpiles of cash during a crash. It's not like everyone just stands to the side with just loads and piles of cash waiting to buy in. And I'm hearing of many people doing that, not only in this article, but I talk to investors all the time and they're sitting on cash. I talk to people that are very liquid and they're just sitting on cash. Maybe they liquidated some of their stock positions and they're just waiting. Oh, when the market crashes, when this happens, I'm going to take all this cash I have and buy it up. That's not really how it works. And I'll explain because I had a front row seat in 2008 during that crash. And it was very different because back then we had a problem with liquidity. There wasn't much liquidity. Everyone was highly leveraged because subprime borrowers were buying properties with high loan to value, sometimes 0% down, so there's no equity. And they were borrowing against that or they were refinancing to a really high loan to value. And so everything was leveraged. There wasn't liquidity. And now we're dealing with the opposite effect. Currently, there's a lot of liquidity. There are a ton of cash investors. There's a ton of cash. Blackstone apparently has $50 billion sitting in one of their accounts. We have crazy inflation. So we keep seeing record high. The last number that got released was 9.1% inflation on the CPI. And that number changes. It could even be higher. We have an issue of there's too much liquidity. There's been not just high demand, but there's been a ton of money created. And so everywhere's flush with cash. So when we're dealing with inflation, the reason why I bring up inflation is because that's the opposite of what happens in the market crash. In 2008 and 9, if you went into a grocery store, prices were dropping. It's very different right now. We have such a strong forward and inflationary momentum taking place. And I'm talking with respect to the real estate market as well. We've had such crazy property value appreciation for the last 10 years, and especially recently, that small changes are only going to have a marginal effect, at least for a while. For example, mortgage rates have gone up recently. Well, that's going to decrease buyer spending power. That's going to decrease demand. But to what extent? Because there's a very, very low supply and there's still buyer demand because there's a lot of money circulating in the economy. And so if we've been appreciating at some crazy rate, then maybe we'll still appreciate just at a less crazy rate. And that's the only effect that mortgage rate increases are going to have. So the Fed is doing rate increases, which has an indirect effect on mortgage rates. And so we see mortgage rates going up. Okay, well, the Fed was doing that years prior to the 2007 downturn. 2007 is when subprime started to fall apart. 2004, the Fed was already raising rates. So what I'm saying is there's a delayed effect and there's a ripple effect. And in 2007, that's when we saw subprime lenders, they froze our applications. Now, I had a mortgage and real estate company at the time, and our mortgage applications to subprime lenders were being frozen in underwriting. And then we saw New Century Financial, a huge subprime lender, and they went out of business in the spring of 2007. And then we saw in September of 2007, Ameriquest, which was gigantic. I mean, there was Ameriquest Arena, I remember, and they went out of business in 2007, September. All this was happening well before 2008, and everyone looks at September of 2008 when Lehman Brothers and Bear Stearns crashed or collapsed as being kind of a milestone in the financial crisis. Again, look at that time frame. Now, you could argue that things move faster nowadays. Okay, I guess you could make that case, but even then, we have so much momentum going the opposite direction of real estate values dropping. It's going to take a lot. So at best, what's happening now might have them level off. Now, I don't think that's going to stay that way forever because I do think values are going to drop. But let's think about how this works. Now, in 2009, I bought a property, and I bought it to fix and flip because there wasn't a lot of buyer demand, and it was very hard to get a mortgage at the time, relatively speaking, relative to now or before the financial crisis. And then you had relatively high supply, you had low demand. These are all things that brought the prices down in 2008 and 9 and 10 and 11. And so I bought a property in 2009. Now, what happened when I owned that property that I was hoping to just fix and flip is that other neighbors in that neighborhood, other homeowners close by, they would let their home go. And so if one person couldn't make payments on their property, then they would go into foreclosure and very likely walk away because they were leveraged out. If you don't have equity, which many people do now, but if you don't have equity, which few people did back then there's no point in keeping a home that you can't make payments on. You just walk away. There's no repercussion. It's not like you go into foreclosure and then you owe the bank like 200 grand or 500 grand or whatever. You can just walk away. And so when one person does that, it makes values drop. And then the next person that's facing the same hardship, they're further underwater because values have dropped. So it wasn't just that they had no equity before, now they're negative equity because their neighbor walked away from their house. And that has a ripple effect. And we saw that with short sales and foreclosures. And so once one person does it, it affects everyone else, and then it happens to another person. And then you go a few degrees down the line, and then people that actually had a little bit of equity, now they're in trouble because so many people in the neighborhood have let their home go that it evaporated all the little equity that other people had. Now they're facing the same hardship of having no equity. So there's a ripple effect. So while I owned this property in 2009, values just kept dropping and dropping every month that went by because there'd be a new foreclosure. And once a few people stopped making payments because they couldn't afford to keep the property, or they wanted to let it go, or maybe just some reckless person just walked away from it, that affected a bunch of other people, and then other people had no choice but to walk away. So it creates this ripple effect. Now, when lending slows down, which is what's happening now, there's an effect that we're going to feel soon, but not yet, and that is all the people that are getting refinance or cash out refinances, all the people that are taking money out, they're spending money. So first off, when a transaction's done, people get paid, right? Real estate agents get paid. People in the title office, people in escrow, the lender, you have all these people that get paid, and then they're out spending money other places. Then you have the person, the principal or the borrower, and they're taking cash out and they're spending it on remodeling. I mean, if you've tried calling vendors for roofing or contractors, it's been insane. They don't even call you back because there's so many people with cash. There's so much cash floating around this economy. It's insane. And so there's all these people spending money on this. Well, once cash tightens up, which is what's happening with the reduction of, or the reduction of loans being taken because rates have gone up and because the Fed is doing rate increases as well, well, that slows it down. That ripple effect takes a while to set in. So I think eventually as rates go up, as the Fed is geared toward doing more rate increases, and as the Fed does that indirectly, it'll have a increased effect on rates for mortgages. I think that's going to slow demand down to a point where we may see supply catch up a little bit, and then we might see the tide turn on real estate. Now, do I think there'll be a crash? I don't actually think there'll be a crash, barring some sort of devastating, unforeseen factor because things are radically different now. Even if we get the momentum we had before, where people are letting properties go and there's a ripple effect, we're not in the same age of regulation and governance that we were back then. The government's highly involved with the economy now, highly hands-on. Look what happened during the pandemic. There was a moratorium on evictions, on foreclosures, there was a delay on student loan debt. There were forbearance programs so that people could avoid something like a foreclosure. Do you think that if real estate values plummet, which is unlikely but possible to happen anytime soon, do you think the government, anyone, regardless of political affiliation, is just going to sit by and just let that happen on their watch and get blamed for it? Absolutely not. You're going to see people step in, and you're going to see the government sponsor forbearance programs with lenders, or mortgage relief, or a moratorium. If there is a financial crisis because there's a collapse of large institutions that are leveraged, you're going to see the government come in and work with these institutions to do forbearances for people that are in foreclosure. So what I'm saying is that, or even a moratorium during a crisis, a moratorium that effectively stops the foreclosure proceedings. So there will be no repeat of 2008, because even when the market begins a downturn, it's going to be highly regulated and very different than it was before. But keep in mind, there's so much liquidity right now, and there's such a momentum, a driving force of inflation, that the idea of values dropping anytime soon is highly unlikely. Will it happen? Yes. Will it happen drastically? Probably not. But when values do ultimately come down in the future, and I still think we have a ways to go, it's going to be highly regulated to a point where if there was a crisis, there are going to be measures in place that are going to prevent the sort of free fall that happened before. Thanks for watching. Please leave a comment.